Hello and welcome everyone. I'm Nadine from Trinity Capital Partners, and we are so pleased that you're joining us today. So, topic that we're talking about today is obviously pensions and inheritance tax in the UK. So, two topics that don't usually go hand in hand, and suddenly they are at the center of a major policy shift. If you are a UK-based professional or an expat with UK ties, these changes could have a real impact on your financial future. I'm joined by three fantastic guests. So David Wells, a former banker turned international financial advisor.
Hello.
Michelle Carey, an experienced offshore advisor. And Josh Thomas. He'll be helping us understand the technical details and what actions you can take. So let's dive in. So let's get started. A little bit of what we're talking about today. Traditionally, pensions have been outside the scope of inheritance tax, but that's now up for debate. The UK government is reviewing this, and from April 2027, that could change. So that gives us just under 2 years to get ahead of it. So let's set a little bit of the scene first of what we're going to be talking about. First of all, the policy shift. Second, what you can do. And of course, we'll be taking questions. So why are we talking about this? David, can you give us a high-level overview from your perspective? What's happening here, and why are people suddenly talking about inheritance tax and pensions together?
Together, yes. Well, I think the first thing to just say is that what we're going to be talking about isn't law yet. It's almost certainly going to be, but it's not law yet. So whereas we've got the indications that it will become law, it isn't yet. So we're not talking about anybody panicking or making irreversible decisions or anything like that. We're really just trying to sort of set the scene for folks. The issue fundamentally is tax. And in the 2024 autumn budget, clause 5 point something, the government stated that they wanted to bring unused pension benefits into estates for inheritance tax purposes from April 2027. That's the remit of all of this. Why? Because pensions, in their view, should not be used as a vehicle to grow assets and then transfer the wealth. They should be used to fund retirement. And this act is really to restore that principle. So controversial, but it's happening. Now, this includes, we're talking here about UK regulated pension schemes. We're talking about something called qualifying non-UK pension schemes, which probably doesn't mean a lot to many people, but it includes something called cure-ops, which are qualifying recognised overseas pension schemes. And a lot of clients that we have at Trinity come back to the UK from a period abroad with these products. So all of this is going to be in scope from April 27. Now, when the budget was delivered, there was a consultation period that ran alongside it. And that lasted for 3 months. It gave the kind of UK financial industry a chance to engage with the revenue, with the government, and sort of ask questions. I think 650 odd responses, so it was quite popular. And that consultation period ended in January 25, and then it kind of went quiet. And I think it was 2 or 3 weeks ago only that the government popped up again, and out came the policy paper. Out came the responses to that consultation period. So it's moved further. It's moved further to, its conclusion. So it's no longer about whether it's going to happen, it's how it's going to work. And as you can imagine, that's going to be quite complicated. And we don't need to go into a great deal of detail on this call about that, but essentially personal representatives of people's estates are going to be front and center of this. And there'll be a fair bit of guidance, I think, in the next year and a half as to how they're going to have to go get this done. And the government and the revenue will be doing that. So in conclusion, the framework is there. Ongoing technical consultation is going on, so expect to see some tweaks, but finance bill probably by the end of this year, and then probably signed into law by spring 26. And that seems to be the runway for delivery and implementation in April 27. So Don't run out and make irreversible decisions, but be aware it's happening, and it's likely that people are going to need to start thinking about it.
So speaking of likely, people are going to have to start thinking about it.
Yeah.
Thinking about your UK-based clients and those with
Yeah.
UK ties, do you think most people are even aware that pensions might no longer be protected from inheritance tax? Or if you weren't proactively telling them, would this even be on their radar?
Probably not. I mean, Josh might have a different answer to that. I'd sort of deal with retail level clients from a UK financial advice perspective. I think it's still a bit early. I don't think there is a general awareness of it. I think the responsibility is going to be on the financial advisors. You know, we're going to have to reach out to our clients. We're going to have to segment our client base and go towards those that are perhaps more vulnerable to this, and we will do that. So it does need to be addressed and prepared for. Problem is, millions of people don't have a financial advisor. That's the challenge. So that's something we need to keep an eye on.
Perfect. Anything there, Josh?
Yeah, I think it's difficult because inheritance tax is already a tax that it's almost like a runaway future thing that you'll deal with at some point down the line. So there's that at play, paired with the fact that this is still speculation in the eyes of the public, and that still quite low. So there's a few things running at play. There's awareness is low. The urgency is also low because in their eyes it's at death. Some people may think of it as someone else's problem. Some people may think of it as, well, I'll deal with it in 20, 30 years. But there's so many things running in tangent, and that is meaning that people aren't taking action. And the same with any tax planning. You've got to take action as early as you can, whether you're selling your company, whether you're trying to avoid a corporation tax bill at the end of the year, whether you're trying to reduce your personal tax bill and remunerate yourself right, or whether it's your inheritance. You've got to plan in advance. You've got to set the runway as long out as you possibly can to make the right steps to reduce your overall tax exposure. And with all of them things running at tangent, that isn't currently happening. Like David rightly said, it is the financial advisors that are going to be at the forefront having them conversations. But for the millions without financial advisors, them conversations aren't going to be happening. And then it's looking at, is it going to be picked up in a conversation in a coffee shop, or are you going to see something on social media? And it's then also counting on the fact that you've got to have enough interest of that and follow through to then actually go and take action, which I don't think is going to happen. So this is going to be a problem that bite a lot of people, and they'll probably start doing something about it after it's already happened.
Yeah.
Thank you so much for that, Josh. Michelle, in your conversations offshore, are you starting to hear this come up, or are most clients still in the dark about it? Do you think this is one of those changes, as Josh mentioned, that will catch people off guard, or especially those who've always assumed their pensions were safe from tax?
Absolutely. And I think, in the offshore arena, as you asked, Nadine, clients are unaware of most things that are happening in the UK or around the world from a financial planning perspective, because they work in this bubble that thinks, in my example, they live in Dubai, therefore whatever happens in the UK doesn't affect them. It's our role and responsibility as qualified financial advisors to bring topics like this to the forefront and proactively take steps to help them with all the financial planning opportunities that come as a result of these changes. And like Josh said, that you're not trying to, catch up or financial plan in the rearview mirror, because that's the worst thing that you can do. It's far better, as Josh mentioned, to have a long runway. You've got time to make those adjustments and to take fully informed decisions. If you're doing it retrospectively, it's too late then. And, both David and Josh were quite right, where a lot of this is only going to come to the forefront and come to people's attention after the fact, which is going to be very sad, because a lot of those opportunities that you could have taken up front will have passed you by. And the only opportunity left is to pay the tax. And it's unfortunate, but I think, like David said, there are so many clients without financial advice and with no trusted advice around them that, unfortunately, like always, that those will be the hardest hit. So hopefully, like today's webinar, we are trying to grow the audience, get the word out there, and hopefully people will have the confidence to come to people like ourselves in order to make the right steps at the right time.
Perfect. Thank you so much, Michelle. Josh, I don't know if you're seeing already what's happening in press and financial circles. Do you think the wider public really understand what's going on if that's not really publicized, or are we still much in the stage of confusion and mixed messaging with what we're seeing?
I think if I was to go and have 100 conversations tomorrow with, let's say, 50 clients, 50 general public, I'd imagine your percentage that would have awareness of this would be sub 10%, unless they've been actively told by a financial advisor or their accountant. And even with an accountant, which, more people have an accountant because they have to, it's compliance focused. So it's not just the advice that you go for an accountant, there is the compliance work as well. So you won't get as many individuals without an accountant, but inheritance tax isn't something at the forefront of conversations with accountants unless you're doing long-term planning. And that's more tax advisor rather than accountant. So I think awareness is sub 10%, in certain demographics, probably sub 5%, and maybe even lower. So I really don't think this is a topic of conversation in many circles. And I think awareness is really low. And I think in tangent with the things mentioned before, which is inheritance tax for a lot of people is a future problem anyway. They're focused on income tax, capital gains, they're focused on the immediate taxes, not the future. Pair that with the fact that awareness is low. And that's why we're on the webinar, I suppose.
Exactly, it is. Thank you for summing that up very well. So as we've talked about, client awareness is quite low. Many still believe pensions are tax-free in legacy. And as you all mentioned, advisors are often first to break that news. So just to have a look at who's at risk, let's talk about who this affects the most. Michelle, in your view, which types of clients are most exposed if these changes go through? Are there certain profiles that might be particularly vulnerable, even if they don't realize it yet?
Look, I think it's very difficult to single out a particular demographic or type of client, but I'd like to think all clients are at risk, because if you looked at just the UK property price escalation over time, it's put a lot of clients into the inheritance tax net without them even realizing it. And a lot of people, even today, are unaware of the allowances and what they can use and what has been used previously by a deceased spouse, etc. And the rules updated a couple of years ago in terms of the allowances. Clients are not even aware of those changes, which happened a couple of years ago. So I think it's very difficult to, pigeonhole everyone, rather that we look very broad brush and say it's going to affect a large number of people, and everybody should actively seek advice from a qualified advisor who is best placed with all the latest information to help and guide each and every client we look after.
Thank you so much for that, Michelle. David, when you speak to clients who've spent time abroad or are thinking of coming back to the UK, how do they usually feel about pensions and inheritance? Is this something they take seriously, or do they tend to assume it's all sorted?
I think, you think that pensions are usually clients' second biggest asset, sometimes the biggest asset they've got. Pensions are kind of, you can touch them. It's here and now. It's, they're all accumulating a pension, or they have a pension, or they've drawn down a pension. A lot of news on it recently. I think from the retail clients I speak to, whether they're resident here or they're coming back from overseas, they kind of got a reasonable handle on the pension side. But that's not to say they've been, they've got everything where it should be, but they're aware of what a pension is and what it can do. Less so with IHT, as these guys were just saying. Very low awareness, and very few people I speak to at a retail level have even considered it. Some have heard of it, but very few have considered it because of something Josh said earlier, which is true, which is people just think it's later down the road. You know, if you're going back to, you know, the people on the slide here, if you're a young family, right, in your 30s and 40s, and you've got, like, you know, tiny children, the reality is that you're probably thinking more about your job, pension contributions, paying the mortgage, insurance. There's so many different things that we have to think about as we go through the journey. And second death for that family might be in 40 or 50 years' time. So do we want them to rush out and worry about this? Well, you know, they should be aware of it, but should they would they be a main category? No. I think that it's those really, if we're talking about who should be more aware of this than anybody, I think it's people approaching or at retirement with large asset values. We know what assets do, you know, investments 5 to 7% maybe a year. Property prices have grown exponentially over the last 10 to 15 years. Assets grow in value. Pensions grow in value. And this is representing a problem for those that want to transfer wealth later down the road. So the closer you are to that event, that obviously by definition, the higher risk you're at. Typically, what's a client going to do? They're going to max out their ISA, they're going to invest money, they're going to make pension contributions, and that's the traditional way of planning for your retirement, about building wealth. But that needs to perhaps be rethought now, because we have to now think about what the objectives of the client are. And that's where all this goes. It's what is your individual client trying to do? It's not going to be a one size fits all here. There's a general philosophy and a thing that we need to be aware of, but how you address that is going to be different. It's quite interesting that one of the larger platforms in this country recently did an audit of their client base. And broadly speaking, it was something along the lines of 9% of their client, these are over 55s. These are over 55s. 9% were accessing their general investment accounts. 8% were accessing their ISAs, and 21% were accessing their pension. These are over 55s. 21% accessing their pension. So that kind of feeds back into what the government's saying, doesn't it? It's saying that not as many people are decumulating as you might think, and this is causing wealth transfer inheritance tax issues down the road, or it will very shortly. I think from a financial planner's perspective, the final thing I'd say on that is that when you're doing cash flow forecasting for a client in retirement, that's basically having a discussion with a client using software and saying, this is how much money you've got, this is the retirement that you want, and this is how much it's going to cost. Is the client going to run out of money, using various assumptions? To me, what this actually is leading to is an equivalent discussion about how can we persuade you to spend or gift some of it? What if you don't spend it based on those figures I shared? What if you actually end up passing away with huge amounts of assets? What problem is that going to give the people that you love and want to leave the money to? Potentially quite significant. So there is an emotional change when people retire. They've spent all their life earning and spending, but when they retire, it can be difficult emotionally because they have to spend their money to retire. They have to draw down from their own assets. So cash flow forecasting is going to be quite a big change here for these people at that stage of their life, because it really does need tight planning, not to make sure necessarily they're not going to run out of money, but that they spend enough and have the retirement they want.
I think that's actually a perfect segue to the question I'm going to ask Josh now, as it's trying to see how we can tackle that problem when a little bit earlier on. So Josh, what about younger high earners or professionals? Do they even realize that their pensions could be part of their taxable estate someday? And what should they be thinking about?
I don't think some of them know what inheritance tax is, to be honest. I think younger earners, especially those that are earning considerable amounts of money, they're focused on earning the money. They're focused on income tax, they're focused on VAT, they're focused on what the personal tax bill is going to be next year. They're focused on the near and short term. They focus on what they can see and feel that's in the short and near future. And for those that are thinking about pensions, which isn't a great deal from my experience, because I definitely deal with a younger demographic, they're not then thinking further afield to, is it or isn't it going to be in my estate value? They don't know what their estate value is. They don't know what the net worth is. They're just thinking about the here and now. A lot of them are just focused on earning that active income. They're not thinking about the passive income of the drawdown from investments further down the line. And rightly so in some scenarios, because the higher your active income, the higher your passive income is going to be down the line because you've got more to invest. But you should start thinking about it as early as you possibly can. And sadly, a lot aren't. And I think that David mentioned cash flow forecasting.
Yep.
Huge. Yeah.
A great thing to do with a tax advisor is also model out what your value of the business is going to be, the ongoing income, and what the tax liabilities look like. Because when you can show an associated number that them or their future families are going to pay, then it becomes real. The perception of it is, okay, this is a serious problem. Whereas just saying 40%, even though it's a huge number, isn't actually enough. But when you put that into a modeled out version of, right, you know, you're going to be worth 5 million based on all the goals and ambitions that you're saying are going to come to fruition in the next X amount of time. On that, you're going to pay 40% away to HMRC. There's a level of anger that builds up at that point. They don't want to give away their hard-earned money. They want to feel like that's going to stay in their family and be passed down to generations. So I think as soon as it becomes real and there's an actual monetary estimation, that's when more action is taken. But first you've got to have awareness, then you've got to have an advisor who understands, then you've got to go through a session of planning and forecasting in order for it to become real. And them steps won't happen for the mass, and therefore it won't become real for the mass, and they won't plan accordingly, and they'll get stung by it.
Amazing. Thank you for the step-by-step process. It's great to know. So just to highlight a little bit of the timing here. So one important thing is from today, many clients only have one annual review, maybe two, before April 2027. So when this could come into effect, that is not as much time as people think. So it's really this window to educate, review, and restructure, as all of these amazing guest panelists have been saying, to talk to your financial advisor about. So what can you do now, David, when you're having those early conversations with your clients who aren't even aware of this issue? What do you usually encourage them to think about first? Is it more about awareness and asking the right questions than jumping into decisions?
It's awareness, as we've just said, isn't it? First of all, you know, most people don't know about this stuff. I mean, again, I just want to repeat, we're not at law stage. We know it's going there, but we're not actually talking about something that's in law. So we just want to sort of repeat that. Some of the things that clients can do now, or the conversations they can have with advisors, are on the screen there. That's not an exhaustive list. That's just a kind of example of a couple of things that you can think about. I think some of the things that can be done now are probably things that could be being done anyway, frankly, that will help this going forward. So, for example, making a will and making sure that you've got the right executor in that will. I don't know what the figures are, Josh should know, but I think it's something like 60% of people don't even have a will in this country, which kind of, is it higher?
Yeah.
Wow.
Well, there you go then. I mean, you know, that's it there, isn't it? It's awareness again, and people, oh, I should do it, but I'll get around it. I'll do it. The number of times I have conversations with people say, I must do that, and they don't. Making a will is going to be really helpful by today, as well as in April 27, when your personal representative's workflow is going to increase dramatically upon a death, because pension is now included in the estates. So that's something I would probably say. I think there's always been an argument when it's appropriate, and depending on a client's circumstances, to consolidate pensions. If you've got 6 or 7 pensions dotted around, that's 6 or 7 complicated conversations from April 2027 based on the way the legislation is going. So that might be something before the policy statement came out 2 or 3 weeks ago that we might be gently recommending. It's probably a little bit stronger than that now. So if I'm speaking to a client and we're talking about this stuff and we're giving them awareness, I'm saying make sure the will is made, and I will be phoning you in a month to make sure that you've done it, or spoken to Josh or whatever we're sending them. I'm going to be making sure that we're trying to reduce your 6 pensions to 2. I think we said it earlier. Most people think inheritance tax is only paid by the wealthy. But with asset prices going the way they have, and think also, as we're talking about pensions, large final salary transfer values have been not so much in the last 4 or 5 years, but there was a time not so long ago where people were drawing out massive capitalized amounts from their final salary pensions, and that's just plonked into the estate, or it will be from April 27. So the government's thinking when this came out was that only 1.5% of estates with inheritable pension wealth would be affected by this. I think the reality is going to be a lot higher than that. So there are things that you can do now. There are things that you should be doing anyway. And don't forget also the final point, Nadine, inheritance tax hasn't changed. Mm-hmm. The way that you can mitigate inheritance tax is that the ways that you can do that are still there. We all have an annual allowance of £3,000 a year. We've got various different gift allowances that we have. You can insure the inheritance tax liability. You've got the 7-year gifting, so you can gift money away from your estate, and as long as you survive 7 years, that falls out of your estate. There's the use of trusts. You can spend it. There's lots of different ways that inheritance tax can be dealt with, and lots of others that I won't go into on this seminar, on this webinar. But you know, there are solutions out there that can be tailored, and the reality is it's probably going to be a combination of these that are going to fit a client's circumstances, not just one of them.
Perfect. Thank you so much. My next question is going to go to Michelle. So with everything still evolving, how do you guide clients without overwhelming them? How do you strike that balance between staying proactive and not rushing into the wrong move?
Absolutely. That's a key question, Nadine, because you're always in fear of clients switching off or thinking it doesn't affect me. Or like Josh said earlier, it's so long away. 2027 is, a lifetime away, and they don't do anything until thelastminute.com, and then it's too late. So I think events like we're doing today, raising awareness through webinars, through newsletters, through the client review process, this is the most proactive we can possibly be, so that we keep it front and center of everybody's mind, and encouraging clients and prospects out there that aren't already working with us in terms of the added value of working with people like ourselves who are qualified to give them advice. And we can sit down with them and look at their financial planning, look at their personal situation, and let them know how this will affect them. And like Josh alluded to earlier, do the calculations, because then you make it very real to them, and they can understand the effect that it's going to have on their nearest and dearest in terms of the value that they may well need to pay away. And they may wish to retain that within their estate, and obviously not write a 40% liability check off to the Inland Revenue Service. It is the second biggest income earner to the HMRC behind income tax. So it does generate a massive amount of money every year for the HMRC, and that's today. That's without taking the proposed changes into consideration, where like David also said earlier, and like I mentioned, just with property prices increasing astronomically in the last 25 years, so many people are going to be caught in this trap, if you like, that aren't aware that this actually falls into your estate. That a lot of people don't think their main residence falls in their estate for inheritance tax purposes. So let's start there. And of course, people don't realize the value of their pension and how that would form part of their estate if these proposed changes go through, and what the impact is going to be on the nearest and dearest that they leave behind. So it's really about education, Nadine, and making sure that we work with our clients every step of the way, guiding them and giving them this important advice through regular updates and touch points so that we are able to keep them up to date and work with them to make sure that they proactively are taking steps to mitigate the consequences of these tax changes.
Perfect. Thank you, Michelle. That actually flows very well into my question for Josh. So, Josh, for people listening today who aren't sure if this even applies to them, where should they start? What's one simple action that they can take now to understand their position better?
So David mentioned before, he said, I can't tell you how many conversations I've had where clients say, I'll get to it, I'll do it later on. And that is because tax, and especially things that are so far in the future, they fall behind a long list of things that we've got to do. That may be part of your business, part of your active income if you're employed. It may be some life admin. It may be getting the shopping in. It may be booking the next holiday, getting a haircut. There's so many things that everyone's got on the tasks to-do list, things that they've got to action, and something that's going to hit you in some scenarios 10 years, 20 years, 30, 40, 50 years down the line. There isn't pain there. There isn't urgency. And pain and urgency motivates action. So in order to curate that pain, like I said before, you've got to model it out and put a monetary amount on it. And that's where I feel that you've got to do an audit of your current pensions, workplace, personal, SIPs, overseas, whatever you've got. You've got to do an audit of them. And you've got to look at valuations and see what the inheritance tax would look like based on today's rules, and start modeling out what they'd look like based on the proposed rules. And based on that, you've got a monetary amount assigned that you've then got to pay and write a check away to HMRC, which is probably going to create some pain. It might not create urgency, but it's going to create some pain, and hopefully that motivates you to act. And if it does motivate you to act, that's when you start putting in place some of the strategies and methods that David mentioned before, and that's gifting, it's alternate structures, it's using your allowances, it's being smart and using tax efficient wrappers, trusts, whatever options you determine that are right for you. But you've got to start by creating that pain, and that pain often comes from understanding what your exposure is. And the way to do that is to speak to the right advisor, model that out, and then set your action plan from there.
Perfect. Thank you so much, Josh. So we're at our Q&A session. We just got a few questions for each of our panelists. So David, in your opinion, is it even still worth having or saving into a pension?
Oh, good Lord. Well, I think broadly the answer is yes. It's still the best product to prepare for retirement. Again, everybody's circumstances are different, but broadly speaking, I would say yes. It's got lots of tax advantages to it as a product, up to 45% tax relief going in, 25% tax-free cash coming out, and so on. Employer match, as we say in the States, salary sacrifice opportunities, saving national insurance contributions. I think broadly speaking, depending on where the client is on the journey, obviously, I think pensions still very much have their place. They're a very generous product. They've just been made slightly less generous.
Do Josh or Michelle have anything to add? If not, we can go to the next question for Michelle. So if a client feels their situation is too small to be affected by these changes, how do you help them see the bigger picture and the potential long-term impact?
I think nobody's situation is too small, Nadine, to be honest. I like to believe we can add value to everybody's personal situation and improve that for them and their family. So it probably just circles back to everything we've already said. Talk to a trusted financial advisor, somebody like ourselves, and set out your personal financial information. David and I, for example, work with a lot of clients at very different amounts, if you like, of earning, different capacities, different asset values. It doesn't hurt to take advice. And I think that's the best starting point, is to start with the advice, and then we can, make those recommendations based on your personal situation. Everything we do is bespoke. Nothing is off the peg, mass market. Everything is tailor-made for your personal situation. So it's definitely worth speaking to a qualified advisor. Doesn't matter if you think it's big or small. Like Josh said, run the simulation, understand what those numbers look like. And then if there are any mitigation tools that we can use for the betterment of the client, we can certainly start educating clients about what's out there and what the opportunities are. The HMRC allow you a number of mitigation tools to reduce things like inheritance tax, and it's up to you to use them or lose them. And a lot of people are just not aware of those opportunities available. And we can certainly work with clients to make sure that they're fully aware and they take advantage of everything that's available to them.
Great. Thank you so much, Michelle. And Josh, when new rules like this are on the horizon, what are some key signs in someone's current pension setup that should prompt an urgent review?
I just want to add one thing to the prior question as well, and then I'll answer that question. Just to make it a little bit more real, if you don't want to sit down with an advisor and model things out, imagine that every time you put money into your pension, 60% goes into your portfolio, 40% goes to HMRC. You've obviously got the accumulation and the yield that you'll get for the rest of time, but let's forget about that for a second. Putting 10 grand of your hard-earned money into a pension, 6 grand goes into your pension pot, 4 grand you're paying to HMRC. Would you put as much in a pension? Probably not. Would you think more about how you could mitigate? Probably. So remove the perception of this being in the future and try and bring it to the here and now and think in that same light. Do you want to give away 40% of your money that you're contributing? I don't know anyone that would say yes to that answer. So just try to think with that in mind, and make sure you're doing the right planning.
Thank you so much for adding to that.
Can you just repeat that second question for me, Nadine, please?
Of course I can. So when new horizons like this are on the horizon, what are some key warning signs in someone's current pension setup that should prompt an urgent review?
So I think, as David mentioned earlier, you're higher risk the closer you are to the event of inheritance tax being payable, because it's in the nearer short term. So where you're in a higher risk scenario, you've got more motivation and pain to go and make that review. For those of you that know that inheritance tax is going to be something that's in the near term for you, and you're not taking action once you've got awareness, you're putting the situation on yourself at that point. But those that are further out in advance, if you're planning on using the product of pensions to mitigate tax, directors can contribute 60,000 per year and get tax relief on it. Corporation tax being at 25%, that's £15,000 tax relief if you're in a limited company. If you're an individual, as David mentioned, it's higher than that, 45% plus national insurance. You're planning on using that as a tool to mitigate tax and to save for retirement. That's warning enough that you need to have a conversation and do some planning. I don't think there's a key indicator that's like a big red flag warning system. If you're planning on using pensions as part of your strategy to mitigate tax and save for retirement, then you should at least engage someone for a conversation to review. If this is going to be something that I'm using as part of my ongoing strategy, how do I maximize the return on investment of using this specific product? And that includes tax. So that for me is enough to go and have a conversation and put it on your action list.
Amazing. Thank you. We do have a question from one of our attendees, Robin. So if this goes into law, will it increase the exodus of people with protection certificates, etc., into ROPS and moving residency? Open to anyone who wants to answer.
I'll let David or Michelle take that one.
Okay.
Repeat that again for me, Nadine.
So if this goes into law, will it increase the exodus of people with protection certificates, etc., into ROPS and moving residency?
I don't know. One doesn't know the answer to these questions. I think it's going to go into law. It might or it might not. I just think it's a little bit early to answer these sorts of questions. I don't. When we talk about people leaving the UK because they're all getting upset by how much tax they're paying and all the rest of it, I think what we're trying to say on here is that there are ways that you can offset that. There are things that you can do. We would hope not. You know, and I think it goes back to the financial planning and the preparation and the incumbency upon us as financial. I worry about the people that don't have financial advisors. I'm not bigging this up unnecessarily, because, you know, why would I do that? But there are millions of people here that either don't feel like they have the assets to worry about this when actually they do. They think they can deal with it themselves when perhaps they don't get round to it, all the things that we've been discussing. So I don't think that there's any need for immediate sort of stuff like that to happen. It will become it might be law, and the law might pass next year, ready for implementation in April 27. So we'll need to see how it goes. The technical consultations are not yet done, but I don't think there's any need for swinging action. What I do think there's a need for is sitting down with a financial advisor. This equation Josh mentioned earlier, which I wrote down actually, but then I've lost it, which is something about urgency and something equals something. I've written it down and I will remember it. It was very good. I think we need to make clients aware that this is coming very, very soon, but we are here to help them. And we can do that through very, very effective means, which are varied. And I think the final thing I'll say on it, this is exciting. I think this can be quite rewarding. I think this can lead to better conversations with clients. I think it can lead to a massive increase in awareness. So for our clients, and we deal with them, as Michelle mentioned earlier, on a very sort of one-to-one bespoke basis, everybody's different. But this is really going to open up the conversation, and it's for the better of everybody, I think.
Great.
Absolutely. And I think, Nadine, just a follow-on point to that particular question, I think people need to be aware that inheritance tax is levied on worldwide assets, worldwide wealth. You don't have to necessarily be resident in the UK to be caught in the net. Again, just highlighting the importance of getting good quality financial advice, because leaving the UK doesn't necessarily mean that you're leaving your tax liabilities behind, or they won't affect you if you no longer live here. It goes back to my earlier point where I deal with a lot of clients in an overseas capacity. And a lot of people think by living outside of the UK, whatever happens in the UK doesn't affect them. It's not the case at all. It often does affect you, whether or not you live in the UK. So just really circling back to how important it is, like David mentioned, to get good quality financial advice from a trusted, regulated advisor.
Yeah, you don't want the tax dog to wag whatever the way around that is. You know, CUROPS of estates. And when you leave the country, you don't become non-resident and nothing to do with the revenue from day one. It's not like that. It doesn't work like that. So again, these sorts of decisions are not what we would be encouraging people necessarily to think about. It's about planning in their country of residence. And if in the end up wanting to go abroad for other reasons, that's fine. But, you know, that's not, this legislation change is not the reason to start packing your suitcase.
Yeah, I've got a couple of points on this as well, because I was having similar conversations pre-budget when there was speculation on capital gains changing, which it did. But a lot of people read some articles that I don't know whether it was planned, but there was some articles of a speculation of it being much higher of an increase. And there was actually some people that packed up and left country, anticipating that capital gains was going to go up to 40% or 30% or whatever the percentage may be. And there was a lot of speculation. Twitter, X, Instagram, LinkedIn, I was seeing posts left, right, and center of people in outrage that capital gains was going to go up to this big number. And it went up, and a lot of people weren't too happy about it, but it didn't go up to the number that people thought. And if you're going to make a decision as extreme as relocating overseas, which may be the right decision for some of you, on speculation of something that still, as David says, is in ongoing technical consultation and then needs to pass, then needs to be published, it's not the right move. And a lot of people look at these measures of relocating overseas, and they also do it for capital gains and CT reduction and personal tax liability reduction, but they do it before they've put everything in place to mitigate to the maximum amount while still being in the UK. For me, if I'm making a decision that's driven by tax, I want to make sure I've at least reduced my tax as much as I can in the UK before I then determine whether that pain is still high enough. Reduce the pain as much as you can with the strategies available to you while you're UK resident, and then determine whether that pain is enough for you to relocate overseas. And then you need to also look at, out of all the things that make an ideal place for you to live, tax is only one of them. Safety is one of them. Weather's one of them. Schooling for your kids, and you've got to rate all of them 1 to 10. And then you've got to start making the decision based on data and facts. Mitigate as much as you can in the UK. Don't make any rash decisions, and engage an advisor to get some ongoing consultation and advice as things progress and develop.
Amazing. Well, that's kind of brought us towards the end of our webinar. Very well summed up. I was going to ask if anyone would like to share their key takeaways. If each one of you could maybe sum up a point in under a minute, would be great.
Speak to an advisor as quickly as you can if you have one.
That was nice and quick.
That was very nice.
Definitely under
5
a minute.
seconds.
Michelle, I'll let you know go next.
Absolutely. David, you stole my thunder.
That's it, isn't it?
And I think that's definitely the key takeaway point from today. Engage with a qualified, regulated advisor in the jurisdiction that you live. It's very, very important, more so now than ever before, so that you can, like Josh said, make the right decision based on your personal circumstances, not on some social media marketing post that may or may not be factual. So let's drive that message home and encourage as many people as possible to seek professional advice.
Yeah, I think awareness is the first stage, and if you're watching the webinar, you've got awareness. Then it's bringing it to the surface. What's the actual monetary amount that I could be exposed to? And at that point, create that pain for yourself. I kept saying this throughout the webinar, but it is so true. And then at that point, let that push you to speak to an advisor. And then same with anything in life, you've got to build a team around you, support you as much as you can on whatever your goals and ambitions are. And that could be a financial planner, financial advisor, wealth manager, whatever name they coin. Start there, and then also pair that with a accountant or tax advisor that works in synergy. Create that dream team for you, because if you ask financial planners, wealth managers, financial advisors, what's one of the biggest drawbacks to your future pension value? It's going to be tax in most scenarios. That tax drag over that period of time. So find a team that works in synergy, plan, take steps, and don't leave it to something that you look at on April 2027.
And we should plug that, I think, in, because I think that's true. I think there's going to be an increasing need for us all to work together for the benefit of a client. It's not just one person, is what Josh is saying there. It's not just one person that necessarily has the answers. So many inquiries fall across so many different aspects of financial planning, and we might not be the experts in each of them. We need to reach out, but we will do that. We will use our resources. We're pretty well hooked up, both here in the UK and with clients with overseas exposure. So I think between us, we can sort most people out.
Perfect. Thank you so much. And thanks again, everybody, for joining us. If you'd like to speak to an advisor, we've got 3 great ones here. Please follow us on Trinity Capital Partners, and of course Josh on Thomas & Co International on LinkedIn. And don't hesitate to contact us for a consultation via your introductory advisor, or just if you'd like any more information, don't hesitate to let us know. And we'll be sharing more updates on our next webinar details soon. And on that note, I'd like to thank Josh, Michelle, and David. Thank you so much for your time today.
Welcome. Good to see you.
Your expertise has been great to listen to. So thanks
Thank
again.
you too, Nadine. Thank you too.
Thank you, guys. Thanks, Nadine.
Thank you, everyone. Thanks so
Cheers,
much
everybody.
for joining us. Bye-bye.
Thanks so much. Bye, guys.